Hello. We're going to look at how to use Pepsico's 2014 classified balance sheet to compute select ratios to participate in this week's discussion. Having read Chapter 2 of your text, you know that the classified balance sheet provides a snapshot at a point in time of a company's resources or assets, its obligations, and what's left for the owners. To improve understanding and to help investors find similar things together, companies group similar assets and similar liabilities. The categories discussed in your books for assets are current assets, long-term investments, property, plant, and equipment, and intangible assets. For liabilities, there are current liabilities and long-term liabilities. So let's see what this looks like for PepsiCo. When you use real company reports, it's not always going to be as neatly done as in your book. For PepsiCo's balance sheet, look at page number 71. The page number is at the bottom of the page, not the PDF page number. So, let's look at the consolidated balance sheet, starting with the asset side. The first type of assets listed in U.S. Generally Accepted Accounting Principle are current assets. PepsiCo has current assets of $20.7 billion at the end of 2014. That's a good percentage of its $70.5 billion in total assets. These are assets that are either cash, will turn into cash, or will be used within a year or the company's operating cycle, whichever is longer. U.S. GAAP says list the assets in order of liquidity, so you don't just make up the assets in any random order. Cash and cash equivalents are easiest to use to pay for things and acquire assets. That means the most liquid. Next are short-term investments, about $2.6 billion. These earn a little bit more than cash, but you have to sell them and convert them to cash to pay for things. The largest type of current asset is accounts and notes receivable, net. Most of these are accounts receivable when customers buy on account from PepsiCo, and it's $6.7 billion. These aren't as liquid as cash because first companies have to collect accounts receivable, and then when they collect them, they get the cash. Inventories are even further away from cash. First, you sell the inventory to your customer. If your customer buys on account, you have to collect the receivable. Then you have to collect the receivable to get the cash. Prepaid expenses are things like prepaid insurance. They provide a resource for a short-term period, so most people do not pay their house or car insurance longer than a year in advance. I pay a year in advance, and it provides me the benefit of service coverage. So it is an asset. It provides future benefits, and insurance will be used up within the year. So these are the components of current assets, and these are pretty similar to the things you've seen in your books. What's different, you'll see, is property and equipment. PepsiCo summarized all of its $17.2 billion of property and equipment in one little line. There are much more details if you look at footnote 4. They tell you how much of this is land, how much of this is building, how much of it's equipment, how much accumulated depreciation, or how much of the cost they've written off over the useful life. PepsiCo gives you a fair amount of information, although they don't summarize the intangible assets in one lump sum. These are assets, remember, that do not have physical substance. These are usually rights, and they provide future benefits. Some of these have limited lives, and they're intangible assets that are amortized. Not many, though, about $1.45 billion. These are things like a patent that would wear out, or a license or a franchise that has a limited life. And because they have a limited life, you write off their cost to expense over that life, similar to when you depreciate property, plant, and equipment. The biggest intangible asset is called goodwill. For most companies, when you see this word goodwill, you have to think about it in accounting in a totally separate way. So this $15 billion worth of goodwill doesn't mean that customers like Pepsi. It doesn't mean that Pepsi's a good corporate citizen. It means that PepsiCo bought another company. For instance, Frito-Lay is one company they took over, another is Quaker Foods, and they paid a premium over the fair market value of the net assets acquired. Most companies will pay more to get control of another company than they will to buy a couple of shares. So this $15 billion means they've taken over another company and paid a little bit extra than what the individual assets were worth at fair value. They have some other non-amortizable intangible assets of $12.6 billion. They might have an uncertain life, and companies that have assets that do not have a certain life, instead of writing them off or amortizing them, they will test them for impairment to make sure that they're worth at least what you paid for them. So altogether now, with the $27.6 billion in non-amortizable intangible assets and a little bit more of amortizable intangible asset, PepsiCo has about $29 billion worth of these assets that do not have physical substance. PepsiCo doesn't have a section for long-term investments, and they place them at the bottom instead of the second position like your book does, but they do own investments in affiliates. These are companies they own stock in. They own enough shares of stock to maybe get a seat on the board or to influence the policy of the company, but not enough to tell them what to do, control them, and add them into their financial statements. So these could be long-term investments. There probably are a few in other assets. It's not really a big category for PepsiCo. Okay, let's look at the liabilities and equity. Remember the accounting equation. Assets of $70.5 billion equals the liabilities plus equity of $70.5 billion. How much of these liabilities are short-term, have to be paid within a year, or an operating cycle, whichever is longer? Well, PepsiCo has short-term liabilities of $18.1 billion. Some of these are short-term debt obligations that bear interest, about $5.1 billion. Most of these are informal debts that are paid in the short term, like accounts payable to suppliers, wages payable to employees, taxes payable to the government. So out of their liabilities, some of them will be paid within the year of the operating cycle, whichever is longer. All the liabilities that are not current, they have to be non-current, meaning you have a little longer to pay them. PepsiCo doesn't give you a subtotal for non-current assets, but you can add together the long-term debt obligations, that's the biggest one of about $24 billion, other liabilities, and this weird thing called deferred income taxes, which we could talk about later in the course, although it's a bit beyond the scope of an accounting introductory course. So you will see that we can use the subtotals, current liabilities and total liabilities, in calculating some ratios next. The thing that you will see in the next page is that these ratios allow us to compare a company to itself over time and to other companies in different industries and different sizes. So, from your text, we use classified balance sheets to calculate ratios. An excellent ratio is the current ratio, which says how much current assets within a year or an operating cycle do you have to take care of these current obligations or liabilities. The classified balance sheet makes this easy to calculate for PepsiCo. And I compared what happened in 2014 to what happened in 2013. In both years, PepsiCo has more current assets than current liabilities, meaning the ratio is greater than 1. And for every dollar of current liabilities, PepsiCo had $1.14 in current assets in 2014. This is a good thing. It has more than enough assets to cover its obligations. We usually want to have a little more than one, but not too much more because current assets cost money. Keeping too much money in cash prevents us from investing it in more profitable uses. If we wanted to compare the current ratio in 2014 of a 1.14 to that of 2013, we would say that PepsiCo was more liquid or had the ability to pay maturing debts more easily in 2013. You'd rather have $1.24 in current assets for every dollar of liabilities than only having $1.14. From your text again, we can use classified balance sheets not only to calculate liquidity with the current ratio, but we can calculate solvency ratios, which measure the ability of a company to survive over a long period of time to repay long-term obligations. The debt to total assets ratio, I like to call this the other people's money ratio. How much of other people's money do we use to finance the resources or assets that we control? Well, if you're Pepsi, we add our total liabilities from the balance sheet and our total assets. Now, unless a company is bankrupt or losing money, liabilities will be less than assets. In 2014, PepsiCo had almost $53 billion worth of assets and $70.5 billion of assets, meaning it used 75% of other people's money to finance its assets. In 2013, it relied on other people's money to finance its assets, meaning every dollar of assets was financed 69% with debt. Some of this debt might not bear interest like accounts payable or wages payable, but they're using other people's money. It's not necessarily a bad thing to have debt, but it does make it more risky that you will not be able to meet your obligations. If you have a higher amount of student loans and you are laid off from your job, you could get into financial trouble. So having more debt makes you less solvent because there's a chance you might not be able to make all your payments in a bad year. So PepsiCo was less solvent because it had more debt in 2014. For debt to total assets, lower is better. Now use this presentation, you can watch it again as a review before calculating the current ratio and debt to assets ratio for your chosen company for the discussion. Good luck and get started, Jaspers. I look forward to hearing your posts.